Good evening, everyone. Happy Wellness Wednesday. I hope everyone is doing fantastic. I'm Mia James, your financial wellness coach, and we are in the middle of our book club. We are working on reading through the book called What the Rockefellers Do, and we are on chapter 8 tonight. So I am just, hey, Jen, welcome, girl. Yes, good to see you. I hope you had a wonderful day. How was your Mother's Day? So I'm just waiting for folks to either come into the Zoom room or come onto YouTube. Yay! I'm getting people in the Zoom room, so that's exciting. Love that. Yes, more and more folks are coming in. Hey, Junior, welcome. Oh no, I wasn't canceling. Tomorrow is vacay day, so I'm looking forward to that. Welcome in to everyone on Zoom. Thanks for being here tonight. So we're gonna jump into chapter 8. I am looking forward to it. And then a little bit more work and then off to vacation. Yes, I'm glad you came too, Jen. Awesome. And we have multiple chats. Hey, Beth. Hey, Kathleen. Feel free to use the chat to communicate. So, just in case you're new here, I want to welcome you officially and also let you know that you can either join me on YouTube. So, I'll be checking the chat over here as well as you can join me on Zoom. So, welcome. Hey, Errol. Good to see you. Thanks for coming tonight. So I got a couple chats going on, so it's going to be real exciting. Because I love all of your comments. Oh, welcome, Kathleen, all the way from Seattle. Love it, love it, love it. And so y'all have options. You can join on Zoom, join on YouTube. So let's get into it. So I love chapter 8 because when I first started my financial literacy journey, I was a huge Susie Orman and Dave Ramsey follower and fanatic. I was like, yes, we got to get our money together. So, anybody, let me know in the chat if anyone here used to follow or still follow Susie Orman or Dave Ramsey. I'm just very curious to know if any of you are like me. I've even seen Dave Ramsey and Susie Orman live in New York City. Like that's how much of a fanatic I was. I'm just curious to know any if anyone else was a fan. And then, of course, I evolved in my financial journey. And from there, I've been able to, make my own conclusions. So, okay, awesome. Beth used to follow Susie. Anybody else? Anybody else in the chat? Okay, awesome. Okay, cool. So, if you have your books, we're going to go to chapter 8. Welcome in, Dwayne. I don't think you can hear me though, because you don't have your audio connected just yet. But we are welcoming you in tonight. So let me go ahead and grab my book because I do also want to show you all some visuals that are in the book. So I enjoyed reading this chapter thoroughly because he was just like, no, do not listen to Dave Ramsey and Susie or he was just like, absolutely not. Okay. All right. So let's jump in. He said the Rockefellers don't take advice from Dave and Susie, which I thought was funny. And he says, unless you are in a dire situation or financial train wreck, neither should you. So this is what I will say as a person who used to follow them. If you just need some basics, they're great from that. But they also have a lot of very strong beliefs, as many financial people do. Even this book is very obviously it's about whole life insurance, and I understand where he's coming from, but I don't necessarily subscribe to that because I believe it depends on who's sitting in front of you and what their actual goals are. Um, and one of the main things, if you don't take anything away from this series, I want everyone here to make sure that if you do have life insurance, that is properly designed. That's his whole point also in this book is that if you have something that's properly designed, it can meet the goals that you set out for it to meet. And if you're not a life insurance professional, you may not know if it's designed properly, but there's ways that you can ask questions about, the longevity of the policy, what will happen if you stop paying, these types of things, because you do want to make sure you are protecting yourself. And I do offer complimentary insurance reviews. So if that's something you need, just let me know in the chat. Um, okay, so here's the bucket. Dave Ramsey, Susie Orman, Primerica. If anyone knows Primerica, they all have the motto buy term, invest the difference. Herein lies the problem. The problem is that a lot of people, and I have clients that come from Primerica, they bought the term, they never invested the difference. So now they're trying to retire and they don't have anything at all because they never got the guidance. Um, Basically, he says, I'm not interested in helping you nickel and dime in the short term. Because basically, what Dave and Susie Orman do, they tell you to cut expenses, right? And he's like, look, I'm not here to tell you to nickel and dime your way into, financial freedom because we want to live. Like Errol's over here on YouTube, and he's out here trying to live. He's like, look, let Mr. Charlie do the work. Okay. So the thing is, we want to live, but we also want to secure our financial future. And he says that his goal also is to help you create economic independence and stability in the long term. And everybody's saving habits and investing habits are different. So for the people who signed up for the term, never invested the difference, and then the term ran out, well, now they don't have anything. They don't have a good savings nest egg. They don't have a retirement. And now, they're in their 50s trying to figure it out, right? And they're trying to retire within the next 5, 10 years. So, Dave and Susie Orman, they're like, whole life insurance only benefits the insurance agent instead of the client. And that could be true because again, it all comes back to design. So basically the point is that I want to leave with you, it's about the design. The policy has to be set up correctly. If it's too low on price on the premium, which is the monthly payment, it's probably not designed properly. So, like he says later on in the chapter, people like the value of what life insurance does for them, but they don't like paying for it. And that's true because if you really want to capture the full value, you got to pay for it. It's like you get what you pay for, literally. And so the other thing he talks about is like, well, mutual funds, right? So me personally, this is not investing advice. I actually do ETFs over mutual funds because the fees are actually higher on mutual funds. And I don't know in the chat. Hey, Faith, let me know in the chat what if you have a take on mutual funds versus ETFs. I started in mutual funds when I was 16 because ETFs did not exist when I was younger, right? But as I increased my financial literacy, I began to realize that the fees were higher, right? Um, and as your portfolio grows, right? Let's say you do the actual thing, you buy a term and invest the difference, your fees get higher and compound as your account value grows. And so over time, your fees could actually be higher than what you're paying for your whole life insurance or your life insurance. So that's important to understand. Yeah, okay, exactly, Jen. Exactly, Errol. Errol said Mr. Charlie is a better laborer than me. Exactly. Amen and glory. Okay. So um he says, this is a quote from the book. As Jack Bogle, the founder of Vanguard, famously said, what happens in the mutual fund business is that the magic of compound interest on returns is overwhelmed by the tyranny of compounding cost. It's a mathematical fact. A lot of people never even look at their statements. And if they do, they don't even know what it means, right? That's not this group here. But I've had that experience where people don't even realize they're paying all these fees for their investment accounts. They're like, I didn't sign up for that. I didn't know that this was happening, but it's happening, right? And so it's eating into their actual returns. And then he says Dave Ramsey claims that you can get 10 to 12% returns investing in a mutual fund. But the vast majority of mutual funds don't get anywhere close to that. So that's important to really understand how what you're investing in, how it's actually performing. And you can even look that up in like ChatGPT, Yahoo Finance, Morningstar, places like that. And actually look at the performance, especially if you have those products. So let's see what we got in the chat. Okay. Ooh. So Kathleen says Susie on PBS and YouTube checked out Dave. Don't like his guilt trip and old cash advice. Excellent. Yes, Kathleen, you are right on there. Yes. Okay, so good. So Beth just did a comparison between SPY and VOO. So for those of you who don't know, those are two ETFs. One tracks the S&P 500, the SPY, and then VOO, I believe that's the Vanguard one. So S&P, the S&P 500, top 500 companies, it makes sense that it's going to have higher fees just because of the nature of the type of um, companies that it tracks. So that's important for you to look at. So I'm glad that you actually checked that out, Beth. So good for you on checking that out. Oh, Trader GPT. Yep. I used to use Trader GPT all the time. So let's get back into it. So we're making sure, because I know many of us on this call are investors too. So I am definitely an investor, right? I'm also, I have insurance. I'm an insurance agent and a financial wellness coach. So great question. Kathleen asked, what does ETF mean? It means exchange traded fund. So basically, ETFs trade like stocks. So you can get into them like anytime of the stock day, anytime the stock market is open, versus with mutual funds, you can only trade them like towards the end of the day. So that is important for you to know. So definitely even look that up too, Kathleen, on do like a chat GPT or Claude or whatever you use, Grok, and ask, what's the difference between a ETF and a mutual fund? Welcome, Stanley. So that is a great question, Kathleen. All right. So welcome. So he also says that um, what the Rockefellers do to properly structure their estate plan is optimally funded whole life. That's the foundation. That's how they actually invest in their estate plan. And that's how they keep it funded, right? Because multiple family members, life insurance policies, the beneficiary is the trust. So if you have life insurance and you have a estate plan, you can actually change the beneficiary to your trust. It doesn't have to be an individual. So that's important for us to know too. And there's also different type of estate plan. So if he doesn't get into it here, I'll get into it at some point. But for example, if let's just say down the road you want to you probably don't, but just in case you do, you want to qualify for Medicaid, right? But you have too many assets because the government does typically a 5-year look back period. If you have all of these, if they look back 5 years and you have all these assets, then you won't qualify for certain benefits, right? Especially medical benefits. So what a lot of people do is put it into a irrevocable trust, meaning you can't change it. And that way, but you lose control of those assets. So you do have to really think about if it's worth it to do things like that. Because again, now you don't have control over your assets anymore. So you would have to put them in the hands of someone you really trust. So if y'all have questions about that too, you can drop those in the chat as well. So this is definitely keep it interactive. Let me see. Okay, cool. I'm just checking back and forth between the book and the chat. So what he's saying here too is with the cash in your whole life policy, that is what you call medium term money. A lot of people they talk about being their own bank. And yes, you can be your own bank. But if you start off the route where you putting in like $250 a month, you're not going to be able to be your own bank quick. Now I've had clients put in like 30 grand up front and then they can start borrowing from themselves right away. And then they still pay their monthly, right? And so there are ways in which you can do the infinite banking, but if you want to go the more, I shouldn't say traditional because it really depends on your situation. If you're paying month to month, and you're not putting in a larger sum, it'll take some time. So that's why he said it's medium term money. But if you could start with a lump sum, like I had a conversation today, you'll start to see your cash grow faster and you can start to use it for opportunities that pop up. And that's what he was saying in previous chapters. Let's say you get a real estate deal. Like I'm betting, my husband and I are betting a real estate deal right now. We're like, bet, okay, where are we getting this money from? Right. And we have different assets that we can pull from. So we're not pulling it just from our, you know, paycheck money. We're like, no, we're going to leverage an asset to get another asset. And that's the same thing you could do with your life insurance. So I'm just curious, has anyone here in the chat leveraged an asset to get another asset? I'm sure someone has. I just want to know. I just want to know. Tell me what you did because that makes me excited. Okay. So we're going to break down the math right from the book. So I'm actually going to show a visual on this part, but let me know in the chat. Just let me say asset for asset, right? If you switch asset classes, you went from one asset to another asset, let me know in the chat. I want to know. I'm going to take a sip of my tea. And now we're going to get into some numbers because, of course, this is all about numbers, y'all. Like, that's the most important thing is to understand what are you talking about. Ooh, okay, let's see. I see something set. So Jen said, if my assets are in an irrevocable trust, then does that allow us to qualify for things like Medicare, or is the trust still part of their evaluation? It can allow you to qualify for things like Medicare, Medicaid, things like that. But you got to understand if you can irrevocable, so you can't change it. And that is when you want to make sure that it's in the right hands. Because like I do have a client going through that right now because okay. So essentially paying for long-term care out of pocket, which is like I think it's 7 grand a month, still paying a mortgage. So assets are slowly depleting. And in order to be able to protect the home, they're putting it into an irrevocable trust. Now, she trusts, you know, who's going to be her executor, thankfully, and they're good people. So that way she'll still be able to leave an inheritance. So that's really, really important when, especially if you are considering doing your estate planning and who your executor is, you don't even have to have somebody you can actually hire a third party executor as well. So you do have that option. Um yes, go ahead, Jen. Jen did asset for asset. She just did an asset transfer. And that's what you can do because she may you may have equity already going into your home, and so it can bring even more value than a previous asset that you have had. So congratulations on that, Jen. That was a boss move right there. So these are the kind of conversations I want us to be able to have, like how do we leverage the assets that we already have, or are we thinking about having, right? Because you might have like 30 grand laying around in a savings account somewhere and it's making 0.01%. You you can have it in one of these policies and not only have the death benefit to leave as an inheritance, but now you have this cash value. Because the policies that I've set up, the rate of return is somewhere between 5.25% and 7.45%. Typically, it could be more. Like I just did a client review, her return's like 11.2%. So it can go much higher depending on what it is. So let's get into the numbers. Okay, let's get into these numbers here. All right, so he says Michael does the math. So in this case, I'm going to share my screen with y'all so you can actually see my little highlights and all the numbers because that's the main thing. Is to have visuals and really understand where we're going. So YouTube chat, I'm not going to be able to see you for a moment, but I'll be back. So, because I'm using 2 screens, soon we'll have 3, but not yet. All right. So hopefully y'all can see my screen. For those of you who are on Zoom, let me know in the chat if you can see my screen, okay? All right. Boom. Michael does the math. So, oh, we got new folks coming into the Zoom room. Excellent. All right. So here's the breakdown here. He said, so with whole life, basically with any type of permanent insurance, at some point you can actually stop paying premiums. This is important for you to understand. So there's a way that you can pay it up and be done with it. Okay. Um, The next thing is he says that anytime that you want to reduce premium payments, this is important. You want to do it after 7 years of having a policy, right? Because this is, again, what a medium term product. Important for you to understand. Now, he said this option is irreversible. With the policies that I do, is not irreversible unless you have a contract that specifically says 10 years, 20 years. If you do not have a contract that says that, you can actually pause and let the cash value take care of the cost of insurance. Okay. So that's important for you to know. Now here's the way you know that it's properly designed. So the way that you can maximize cash value is have a lower death benefit, right? The lower the death benefit, but you pay in the maximum amount. Okay. Because the cost of insurance is lower on a smaller death benefit, and that allows your cash value to grow faster because most of your premium that you pay into it goes towards the cash. That's the hack. Okay. I just gave y'all the secret. Now, of course, let's just say you have a specific need. You need half a million, depending on your family's needs, and you need to go ahead and pay that. That's fine, but you can still pay more into it than what was quoted to you to maximize the cash value. But the cost of insurance is going to be higher just simply because the death benefit is higher. Okay. So we kind of talked about this. So let's get into the numbers. He says the following chart shows a client paying 36 grand per year into a whole life policy for 20 years. So they did what's called a 20 pay. He said at the end of this period, the client had $1,089,453 in cash value. And at that point, they took the reduced paid up option and stopped making payments. That's what it's called for whole life, reduced paid up option. All right, let's get into the numbers. All right. So as you can see here, they paid in 36,000. They got it when they were 30. They did that all the way until age 49. Now they want to kick back at 50. They want to be retired. And here, over here, this is their total cash value. Okay. So this is how you see real numbers and how people actually really make real money or, get real money. Okay. And let's do the math. What's 36,000 divided by 12? I should know this. It's 3,000, I believe. Yeah. So they're paying $3,000 a month. But after 20 years, they got $1.1 million, basically. $1,089,453. And originally their death benefit was 1.2 million. But now, because the cash is a portion of the cash is added to the death benefit, now they have almost $3.4 million in death benefit that they can pass on to their family. Now, I think that's pretty good. And now they can use this money, this 1 million, as tax-free retirement money. Okay. And this rate of return that's shown here is very, very conservative at 5.35%. Okay. So they got 1 million in cash, and then they have their death benefit over here, this 3.37. So if they, use this cash for whatever, they still got this death benefit over here. But in certain other situations, you have to pull dollar for dollar. So any questions on this so far? Thank you, Kathleen. I see a comment in the chat. All right, let me exit full screen for a second and check out the YouTube. Okay, so Jen says high yield banks and options trading make a difference. Yes, absolutely. Okay, good. I'm glad y'all could see it. All right, good. So no questions. So it's pretty straightforward. This is a high level group here. Okay, so I'm not going to go into all this. I wanted to show y'all this math over here. Let me see if I can remember. Okay, how to. I tested it out to see how to make it bigger because it's even hard for me to see. Okay, hold on. If I go full screen, because this is I was like, I don't want this to be all talk. I want y'all to understand the numbers. Okay. I'm gonna have to tell it to you because I don't want to waste too much time. Let's see if I go like this with my Mac. Okay, yeah, there we go. Okay. Ah, now it goes off the page. So what he's showing right here is from 1993 to 2012, the average rate of return for the different indices and stuff, like the S&P 500, the Dow Jones, 10-year US T bonds, right? And he says that like using the S&P 500, the average gain, but as you can see, no, the S&P kicks behind sometimes, right? So let's see, like 95 is at 37.2. It was doing great, right? You see some higher 2003, it did really well, et cetera, et cetera. But the average, right? Because 2008, we remember that's when the market crashed 36.63%. That hurt a lot of people who wanted to retire but couldn't because of the crash, right? So when you're thinking about your portfolio, it's never a either or, it's always a both and. So, I would never tell anyone, "Oh, don't get into the market." Obviously, you have to proceed based on your level of comfort and understanding. But there's all, like I said, it's always a both and. So he's taking this 9.92 average and he did a future value calculation. So what is the future value of this 9.92% return? And he said over 20 years with this level of return, you're going to add about $12,000 a year to an account, right? And he was like, now this is not factual because we know year over year it's not going to be 9.92%. It's going to go up and down as the market goes down. So that's his point. So then what he's saying, okay, so now we have to squeeze this in a little smidgen so y'all can see here. Voila. Right? He says, we know it doesn't work that way. We already talked about that. He was like, after you take away management fees, because if you have someone managing, you're not managing yourself, and maybe it's about a 2% management fee. That's conservative. You have an actual return of 7.72%. Right? And so this over here is showing you the actual market history, right? And he said the actual market return, actual rate of return that you have is about a 4.13%, right? So that's a lot of risk and a lot of uncertainty if you're paying management fees, right? If you're not managing yourself. And so the whole point here, and I know I was really quick with the explanation. Of course, you can always contact me and I can break it down even further. But what he wanted to show you was the difference. And let me get this back in. Come on, Mac, you can do it. There we go. What people teach, like, show you like, oh yeah, it had a 9.92% return and what the actual return would be, and how after 20 years, this account, given the actual numbers, will be about 377,280 versus that 1.1, almost $1.1 million that you saw in your insurance account, right? So I know that was a fast explanation. And I'm like, some people are probably like, what, Mia? What did you say? Look, here, I'll give it to you real quick, high level. Basically, what he's saying is that if you take the actual numbers of the return, like on the S&P 500, right? Subtract the management fees, include the volatility of the market, you're looking at about an actual return of 4.13%. Now, Jen, Errol, and I, we all know that there's ways to capture more of that, but this is just straight, I'm putting into account, I'm setting it and forgetting it for 20 years, right? Same amount, same investment, set it and forget it. That's what this is saying, okay? Not managing it, really doing anything with it. That's a disclaimer. That's important to understand here in this scenario because some people don't want to be involved. They do want to set it and forget it. Versus you do that same thing with a permanent life insurance policy, okay? And you saw what the results were. The results were almost $1.1 million in cash value that you can access tax-free. Now, anyone will tell you that if you do sell any of your assets that are directly in the market, if you don't have any, there's I'm sure there'll be some losses in there, but depending on how much gain, you might have more gain than loss. So now you're paying what's called capital gains taxes. So not only is the return 4.13%, they didn't even talk about taxes. They didn't even mention that you're not getting that whole. They talked about fees, but they didn't talk about taxes. So that's really important for you to understand, because when you pull from your life insurance policy, there are no taxes as long as you did not make the policy. That means you didn't pay above the IRS limit. All right. Y'all have survived another in-depth estate planning, life insurance, tax talk. I'm very proud of y'all because I know it's not the easiest thing to understand, which is why I wanted to show you the book and show you the numbers. But every week we're going to just keep building on this. Okay, so I see a question here. Can I use my life insurance policy as a distributor for my beneficiaries to pay my mortgage if I'm dead or alive? Absolutely. So if you're deceased, it'll be paid out as a tax-free death benefit. Okay? So excellent question. If you're alive, then you can take distributions, either in the form of a loan or a withdrawal. So yes, you absolutely can do that. Great question, Jen. So any other questions? Because we're gonna wrap up for today. Can I take from my policy to pay the IRS if I owe? Yeah, if you have cash value, if you have access to cash value, you can pay. You can use your cash in your life insurance policy for anything you want. There's no restrictions. That's the beautiful thing. And for my clients that I have who want to actually retire before 59 and a half, I do recommend that they actually get I recommend that they actually have something like life insurance to pull from, because at the end of the day, if you touch like your 401k, 403b's, 457 Roth IRAs, traditional IRAs before 59 and a half, there's a penalty. So if you want to retire at 50, 51, 52, 53, 54, 55, 56, 57, 58, 59 before you're 59 and a half, where's the retirement money coming from? And I think that is crucial for everyone to understand, because a lot of people want to retire early now. So, you know, and the people are not necessary, and also, how do you diversify your taxes? Because yes, you can obviously make money from your stock portfolio, um but it's, you if you have a gain and no losses or very little loss, then you're paying capital gains taxes. So you also need to understand that aspect as well. So you have to weigh out all your options. That's all I'm saying. All right. Well, thank you, Jen. I love having you, and thank you for all your wonderful questions. Next week, come with questions, y'all. That's what that's really what I live for, is the questions, the chat. I know this is a lot of very detailed information. So, if you're like me, or you're going too fast, slow down, re-explain, I'm totally fine with that. So until next week, I'll see y'all next week. I'm going on a little short vacation. So, but I'll be back next week. I will not be mobile. Thank goodness, because y'all know how that goes when, when I'm not settled. All right, y'all have a great night. Love you all, and thank you for coming. Good night. Yay. Thank you, Stanley. Awesome. I'll be looking forward to the questions.